Summer is here, and that means trips to the beach, days in the sun, and plenty of Carolina blue skies. It's also the busiest season for buying and selling homes, so it's the Sharp Mortgage team's favorite time of year. Are you thinking of buying a home this summer in our beautiful area of the Triad of North Carolina? Well, look no further than Highlands Mortgage, where exceptional service meets unwavering dedication. They understand that purchasing a home is more than just a transaction. It's a milestone. Their team ensures your experience is smooth, responsive, and genuinely caring from start to finish. So why buy a home this summer with them? Well, you get personalized customer service. They pride themselves on offering great customer service tailored to your unique needs. Their responsiveness is unmatched. They're always just a call or email away, ready to promptly address any questions or concerns. And of course, you'll get expert guidance. You can rely on their knowledge and over 20 years of experience to navigate the often complicated world of home buying with confidence and ease. Summer's the perfect time to find your dream home in Winston-Salem, Greensboro, or anywhere in the North Carolina Triad. Let the Sharp Mortgage team guide you every step of the way. With their caring and responsive mortgage team, make your home buying journey this summer memorable. Just call 336-575-9448 to get started. 336-575-9448.
This is the Triad Podcast Network.
Hey everyone, welcome to another episode with Jennifer Johnson, our certified financial planner from Three Magnolias Financial Advisors based in Winston-Salem. We are recording this during a very volatile week for the market. If you've been following the news, you know that we're recording this on Wednesday, August the 7th. And so the previous 2 days, you're aware that there has been quite a bit of shifting in the market. And so, Jennifer, we had a topic all planned out to discuss today. And then, over the course of 48 hours, we've completely shifted gears because it was important to offer some perspective on what's happened and We'll talk about the micro and then we'll talk about the macro in terms of what's happened along the markets. But let's begin. I just kind of want to give you the mic to summarize as best you can and what you would like to offer to people to explain what happened over the last 2 days on Monday, August the 5th, and then Tuesday, August the 6th, as we're recording this on a Wednesday the 7th.
Yeah, Monday definitely was the most dramatic, right? And it really started last week. I think it was Thursday. We got the unemployment report, right? And that typically comes out monthly for those that kind of follow economic data. And what you're looking at there is, how many folks are out of work? Does that look like that's improving from the previous month, or is it, trending in the wrong direction? And the big headline from last week was the unemployment rate went from 4.1% to 4.3%. And that sparked a lot of volatility, really kind of started on Friday, but you're right, Adam, the really big movement happened on Monday, where we saw, if you follow the Dow, it moved 1,000 points down, right? And so we know that gets people's attention. You definitely want to be flexible on what we talk about here and make sure it's relevant and timely, for our listeners here. So that's why we changed gears here. So I bet you're probably wondering, like, 4.1 to 4.3, like what, why does that mean 1,000 point movement, in the Dow, right? Like, I can see you nodding, like, yeah, that doesn't make, any sense. And it doesn't sound like a lot, right? And it's not a lot. And I think that's maybe important for people to know. When I took econ or economics classes, we were taught that anything below 5% was full employment. Does that make sense? So anytime you have employment, or unemployment, I should say, below 5%, you basically got, people employed. It's not, where you've got situations where people are widespread out of work. So it doesn't sound like bad news, and so why did the market respond like that? So I think a couple reasons. One is that, that trend is starting to go up, right? So he said it was 4.1 the previous month. It's now 4.3. And so we see that moving in the wrong direction. And whenever you think about the stock market is a forward-looking thing, right? It's trying to look ahead and say, okay, is this company I'm going to buy shares in, are they going to provide greater profits and return that to me either through higher share prices and or a dividend in the future? So you're looking at what's going to happen with that company in the future. That's why you buy it. And if you look at economic indicators, if it looks like things are going in the wrong direction, that can really, really spook the market. So that data point, made people very nervous. And I can expand upon that a little bit more in that, we've seen a lot of gains to this point in the year, right? It's easy to get spoiled a little bit, right? In that we've seen such a nice return so far this year. And a lot of that has been because we really thought and feel like, and this likely may still be the case, that we may not be headed for a recession, right? So back in 2022, the Fed raised rates a ton. We've talked about that and the impact on people borrowing money and interest costs and so forth. A lot of times what happens after that is a recession because it's so difficult on the economy. Toward the end of 2023 and so far here in 2024, so roughly the last year, you could say it started to look like, hey, inflation's coming down. All our economic indicators are good. Maybe we won't have a recession after all, right? So maybe the economy is going to be okay. People are still employed. They're still spending money. This is looking good, right? So we were all worried. 2022 was such a tough year, and really most of 23, the market was down until that fall, really. So we had this period of declines, and then since that point, we're like, okay, maybe things are looking better. And so when we got that unemployment number, that's one reason the market reacted so swiftly and so sharply down, is that all of a sudden it looked like, maybe we are going to have a recession. Maybe this is the first sort of indication that maybe we will have a recession. Does that make sense so far?
Yeah. So it basically was bucking the trends that people were seeing and delivering something unexpected, even though, like you said, it's a 0.2% difference.
Yeah.
It was going in a different direction, and it caused a little bit of skepticism in terms of whether we were going to be heading toward a recession. So
That's right.
I have a million different follow-up questions. I'm trying to figure out where to start here. I guess I'll start from we'll stick to what happened on Monday. And you mentioned the Dow dropping, what was it, 1,000 points, right?
Yeah. Right.
You mentioned something before we pressed record about perspective, because we've been in a pretty good time right now in terms of where things have been heading from the markets, and all the indexes have been trending upward for quite some time now. And you said something about, well, if you look at it from a percentage standpoint, you have to give more context to that, because 3% drop of what the indexes are right now versus a 3% drop of what they were, 2 years ago is much different, because we're operating at a much higher level right now. Yeah. So what can you tell us about perspective of what happened from a numbers standpoint?
Yeah, I think that's really important to understand, because I think, when you hear the headlines, oh my gosh, 1,000-point drop on the Dow, that feels very dramatic, and it is. It equates to about a 3% movement. And important to remember that 3%, of 40,000, when the Dow is at 40,000, is a much bigger number than 3% when the Dow is at 20,000, right? So it feels more dramatic when you hear the headline. The impact on your investments are likely the same. though. And so that's important for people to understand. So it's a percentage movement. So if you have, it's just sort of like if you have $1 million, a percentage movement in that is a lot more dollar impact than if you have 100,000, right? But if you think about it as a movement in a stock price, the percentage might impact you the same. I don't know if that makes sense or not. So I think that's one thing that people need to keep in mind, is that it feels more dramatic, but those percentage movements are actually quite common. And we can put that in a historical perspective too, if that would help, you think.
Sure. Yeah. I think we've done this in the past whenever, we've been doing this podcast for long enough where we probably had a conversation similar to this in 2022, the last time we
Sure.
had a dip like this. But yeah, maybe if you can offer any sort of historical context,
Yeah.
that might be helpful.
Yeah, I think so. I mean, if you look back at markets, I mean, we know they don't always go up, right? I mean, you're going to have these time periods in which you're going to have declines, and they're actually quite common. Really, what we've seen so far this year is uncommon in that we have not seen any downtime. And I think that's where you're headed there, in that we've had just this almost steady march higher. And that's really unusual. It's much more normal for you to have more ups and downs throughout the year. I mean, it's quite common for you to have, movements of around 5% 3 times a year, right? And I said Monday was 3%, right? So remember, that's not unusual at all. We typically have that multiple times throughout the year. If you put a few bad days together, which we've had more than just Monday, we've had a few bad days, right? Kind of, I mentioned it sort of started last week. It's not unusual at some point during the year to see, stock market indices go down as much as 10%, right? So that happens, and that's about, on average, about once a year. Now, timing, as folks have probably heard me say and others say on this, is very hard to predict, right? You just don't know when. I think this is a good example. I would have been very surprised to learn if you told me at the beginning of the year, hey, the market's going to just continue to climb upward, all throughout the spring and summer, particularly in an election year. I think we probably talked about this earlier in the year, in that elections, typically follow certain patterns. They certainly don't always. And this is a good reminder of, you just can't go by trends. But you a lot of times see volatility in the spring and early summer. This time we haven't yet. I think we're kind of seeing that now, just because of some of the uncertainty that elections bring. And so, I would just remind folks that, remember, it's not unusual to see percentage movements. And when you hear the Dow is down 1,000 points, it might be helpful to say, oh, that's 3%. Remember, I heard this woman on a podcast say, you typically see 5% movements multiple times during a year. Like that's not unusual. It's weirder if you don't see them. Does that make sense?
It does. It does make sense. And I was going to follow up by asking, would you have predicted a year ago, 18 months ago, that the Dow would have reached 40,000?
No. I would have thought we'd hit this point, much earlier in the year. In fact, we probably think of it differently than most people, in that if you see the market continue to climb without any sort of, downtime or correction, if you will, we start to get worried that maybe we're walking into something more nasty, than that. So in many ways, it's healthy to have these kind of movements, because if you don't, you can kind of walk into bubble situations. And I don't think that's necessarily where we are. I think it's just a market that's looking really closely at any data that comes out, any indication of where the economy's headed. You're going to see a reaction. And typically with markets, you see an overreaction. That's just kind of how they work in the short term, in that, news comes out, and it's kind of like herding cats. They'll just overreact, in one direction or the other. Now, in the long run, I certainly would say we feel more comfortable, in the direction of the market, following earnings, following economic trends. But you're going to have these moments in which I think, particularly now with the market being nervous about an election, a market being nervous about conflict in the Middle East, whenever you have a news story like, unemployment has ticked up, even if it's not a lot, even if, you could talk to an economist who would say, well, that's full employment, you can certainly see the market, move in a big way. So one thing I would hope people take from this, because that's not a really exciting story, right? That's not something that's going to get, turn people's heads. Is like, this is a normal market movement, right? So there's going to be a lot of voices, in traditional media, maybe social media too, that will try to get your eyes on that. And I think sometimes people, make bad decisions. They react to that, what they think is like a world-changing event, something totally new, some indication that all the world has changed and things are different. And in fact, when we look at it, we're like, oh, that's pretty normal. That's, we don't like it. I'm like, that's not what we want either. But it's to be expected. And I think what's important for people is to understand that in the context. And then I think that leads to, what do you do?
Life is full of celebrations, birthdays, holidays, life milestones, and so much more. And who has been helping generations of families celebrate these events? Our friends at Dewey's Bakery. And even if you aren't planning for something in the near future, you don't have to wait to enjoy something savory and delicious from Dewey's. Maybe you just need something to get you through your Mondays. Drop by every Monday for a free Cake Square Day. No purchase necessary. Just come celebrate the start of a new week. So, if you're hearing this ad on a Monday and you're in your car, reset that GPS and get to one of their 3 Triad locations immediately in Winston-Salem at Thruway and Renolda Manor, plus one in Greensboro at Friendly Shopping Center. And any day of the week, you can find the perfect item with fast and easy ordering options at local.deweys.com. Plus, Dewey's does so much to help celebrate our community. To date, they've given back over $4 million to local schools, churches, and other nonprofits. Your next celebration isn't complete without something special from Dewey's Bakery. Dewey's. Celebrate every day.
So I think that's a great transition into the next part of this conversation, which is, you're seeing all of this unfold on Monday, and now maybe transitioning into more of the macro part of the conversation, which is, we'll see dips like this in the future. Like you said, this is what happens, and so it's important that people know how to navigate when it's going up and when it's the ride is moving down. And so, what do you typically tell people? Where do their heads go when there is, a 3% dip in one day is not insignificant. And so, what do you tend to advise people that are concerned about their investments?
Yeah, I mean, I think the first thing is to remember it's rarely are these events time to panic, right? And, throw all your plans out the window. I mean, usually if you react to something like that, people typically have 2 instinctive reactions. One would be to want to sell or get out of all their investments. And then 2 would be, well, I'm not putting more money in that. I'm not buying more, right? Because this thing is going down and it's scary and frustrating. When if you can step back from that a little bit, you certainly don't want to sell your investments at a time they're down, right? That's exactly the opposite of what you want to do. In fact, if you had done that, the market has been up Tuesday and so far today, as we're recording. And so if you freak out and sell all your investments on Monday, well, you lost 3% on Monday probably, and now you've probably lost 1.5% in missing out on that response. And that's, I think, points to, we've always said it's difficult, if not impossible, to time the market. In my roughly 20-year career as an advisor, that's something we've consistently shared with folks. And I think if anything, that is more true today, in that. I will say percentage movements, I think, are pretty consistent, and have been there throughout history. And I'm sure we'll continue to see that. I think one thing that is different is that the market moves more quickly today than maybe it has in the past. I think that's because of a lot of more participants in the market. It's more of a global market. And so you see things, maybe it's due to computerized trading. I think it's probably a whole host of factors with just everything in our world moving more quickly, is that markets move more quickly. And I think that speaks to how difficult it would be to simply time those movements of now's the time to sell all my investments, now's the time to buy all my investments, because those things just happen so quickly. I think also one of the things that I always encourage people to do is, a lot of times it doesn't happen necessarily if it's just a bad, few days. If it's, maybe a bad month or quarter or something, a lot of times people will look at their IRA or their 401k or whatever they may be putting money in, and they'll get a statement and maybe they're disappointed because, as your account has grown, right? We talked about it before, maybe you've got, $100,000 account, it goes down 3%, which is $3,000. You've been putting $100 in there, and you look at that quarterly statement and be like, dang, I put in $300 and that thing's down 3,000, right? I mean, it just eradicated, all my money. And so people get really discouraged. And so they'll stop adding money to that. Well, when is your best opportunity to buy stuff, right? It's like during these times. And so one thing I always try to make sure I share with folks is, one, you don't want to react and change your investments because of a decline. Normally these declines, they're swift, but they don't last that long. But they cause people to do things that they sometimes regret because of how quickly things turn around. And then two, you want to make sure you don't stop adding to things, because that's your best opportunity, because you get more for those dollars. Does that make sense? If you're putting $100 in, the prices are now down by, say, 5 or 10%, depending upon how swiftly that market has moved down or how much it's gone down. You get more shares. You get 5 or 10% more shares for the same $100.
Yeah, it's what a lot of people refer to as buying the dip, right?
Yeah, that's right.
I'm sure a lot of people did that on Monday, and
Sure.
but it's like anything else. I mean, thankfully the dip was only one day, but sometimes they last longer, sometimes they don't, and so there's always risk involved in whether you're buying the dip. But yeah, you in principle, buying something at a lower share price is going to give you more value. So I wanted to ask you about the importance of, this is always something that, from day one, one of the, I think, cardinal rules of investing is diversification, right? And I want to ask you about the importance of that, especially when there's volatility in the market, because maybe most of the stocks that are impacted are big tech stocks, and if you've got all your money in that, then you're gonna be impacted a lot more than somebody who isn't all in one particular industry. And and for example, all these stocks are taking a hit, and Uber has a great day or 2 days. They have a huge jump because maybe they just had an earnings report.
Right.
So, maybe speak a little bit on the importance and re-emphasizing the importance of diversification to avoid getting hit too hard by something like this.
Yeah, I think that's a great point, Adam, and certainly something we think is important. As people have heard me say, I think these times too remind people. I think it's easy to feel like you're comfortable with risk when it goes up consistently for a year, right? And now's a good reminder that things don't go up forever, and you need to be prepared for declines. So I think there's a couple things that people need to keep in mind. One is that you need to understand your time frame on your investment, right? If you're a long-term investor, you're 25, you're 30, this is a retirement investment. I think you certainly want to be diversified in that you don't want to own, just the NASDAQ and just the top 5 high flying tech companies, because even if you do have a long time on your investment, it's still pretty shocking to see how quickly they can move. And you can take like 2022 as a really good example. That's a bad experience for most all investors. But it's particularly bad in those technology area companies. I mean, they're down over 30% as a general rule and more, in particular companies like you're mentioning. So, I can't stress that enough, that you do want to be diverse in what you own. I think even if you're an aggressive investor, and almost exclusively in stocks, you still want to own a broad variety of companies. I think today that is easier than ever with the advent of, different index funds, ETFs, things that are just easier for smaller investors to get started with, and get a broad, good, diversified, investment. And then the other thing I would say is, this is a good reminder that how quickly things change. So, if you're getting close to a goal, if your child is 17 and they're going to college, if you're 62 and you're going to retire in 2 years, you need to be careful on, the risk of the investments you have. And that's a really good time. I think those things are just really hard for people to do on their own. And, certainly don't want this to be like a shameless plug for, advisors, but I do think that is really challenging for people to figure out. And I think these are times in which that bubbles to the surface, where maybe people felt like they were making the right decisions, but now they've realized, oh my goodness, things can change in a day, and I need to be prepared and make sure I've got the right balance, of not just stocks, maybe, right? I mean, so it's a couple things. It's not just, making sure you have different companies, but, you may not need to be all in the stock market, if you're getting really close to using your money, because the stock market, we feel comfortable with what it does over time, but, from year to year, certainly from day to day, if anybody who's honest with you, I think would say, we just don't know what that brings. And so the way that we deal with that is to, as people get closer to goals, slowly shift away from things like stocks that have, though, more growth potential, more volatility, and figure out how much of that investment needs to be in things that are more stable, maybe more income producing as they get closer to that goal.
Who's ready for movie night? Our friends at the Ginther Group Real Estate are proud to sponsor another season of innovation and cinema at Bailey Park in downtown Winston-Salem's Innovation Quarter. The next film is Blade, starring Wesley Snipes, on Friday, August 16th. Bring your chair or blanket to Bailey Park for a great night of cinema from Aperture and beverages and food from a variety of local vendors. Pre-film fun begins at 6:30 p.m. and the movie begins at dark. These magical movie nights are made possible by the Ginther Group, the real estate experts we trust and showcase right here on the Triad Podcast Network. Check their social media for info on each upcoming movie night. And for your real estate needs, call 336-283-8689 or visit theginthergroup.com. Buying, selling, investing, or just learning. Whatever you need, start now. And like me, you can become a Ginther Group client for life.
Last thing I wanted to ask you about is, I want to be careful not to ask you to predict what's going to happen over the next few months, but obviously everyone knows we're in an election year, and these next 3 months are going to be very interesting nationally.
Sure.
I guess the way I'll ask the question is, in the past, during an election year, a presidential election year especially, is volatility something that is common in the months leading up to a general election?
Yeah, it is. Yeah, I think, a lot of times we see it earlier in the year, like maybe more primary season. in this case, primaries, they were pretty quiet, right? But we had a pretty big change when Biden dropped out a few weeks ago, right? The market didn't really react right away, but I think it just had sort of an undercurrent of nervousness, as I mentioned before, of like, oh, what does that mean? Do we know who our next president's going to be? What are their economic policies going to be? Is Harris going to be like Biden? So I think there definitely creates some questions. And if there's, anything the market doesn't like, it's uncertainty. And so what we typically see, in elections is the more uncertainty there is about that, who's going to be the president and what are their policies going to be, the more the market is up and down, right? It's kind of all over the place. And then as the election gets closer, typically you'll start to kind of sniff out, okay, who's leading, who's going to be the most likely next president. And then the market kind of calms down as that gets, becomes more clear. And let me say too, when I'm sure we've got a whole host of people with different political feelings, listening, in most cases, just getting the answer, is what the market wants. It's not as worried, about who the victor will be, as opposed to just kind of getting that behind us. And so that maybe could maybe help people understand that too. And that it doesn't, it's not as if one person wins, the market shoots to the moon. And if the other one, we all fall to our deaths, right? So the outcome is not typically like that dramatic. And it's more than anything, you can sort of deal with what comes if you know what's coming, right? And I think what makes the market nervous about elections are just kind of not knowing, maybe if it's an unknown candidate, I think that brings a higher level of uncertainty. And I think that's one reason maybe the market had been fairly quiet, up until recently, in that both Biden and Trump were known candidates, right? So you kind of know what you're going to be dealing with either way. And so there wasn't a lot of reaction yet. I think we could see more volatility until we know more about that. And then I think things kind of settle down after that. Yeah. Is that helpful? Kind of address that a little bit.
That makes a lot of sense. And yeah, to underscore it, it's the market doesn't choose sides. The market does not affiliate with one party or another. It just likes answers.
Yeah. That's right.
And maybe there's some correlation to the fact that, I think people maybe wanted to get political in terms of who was responsible, which party was responsible for what happened Monday versus what happened Tuesday. And maybe it's just the simple fact of the market rebounded at the same time that, Kamala picked a running mate. And so we had an answer. We had an answer. We knew who was going to be on the ticket for the Democratic Party. And so, that does make a lot of sense. And so the market just likes stability and certainty and so anything that might come out there that makes you question who's going to be in charge can sometimes spark that volatility. That makes a lot of sense. Well, I'll give you the chance to if there's any other final thoughts or final words you'd like to say about where we've been or where we're heading.
Yeah. I mean, I'll just leave folks with, if you look, if history is any context, certainly we don't know how this year will go, but historically, election years haven't been bad years. So I wouldn't want to scare people necessarily with that. I think more the market is looking at things like the economic data that'll come out. It'll look at earnings, for corporations. It'll look and see if the consumer is spending money as they normally would, to see how it moves. And I think it's important too to understand, markets are going to move from day to day. It's really hard, if not impossible, to predict those movements. So I think what we would encourage people to do is to make sure you take a long-term approach with that. Is it a quality investment portfolio that you feel good about and not worry so much about, a day-to-day, or week-to-week or even month-to-month movement, and take a planning approach to your goals too. And, keep that in mind as you see headlines that, if you're planning for a goal, to educate your kid, for that's kind of going to go to school for 15 years, you don't want to get too caught up in today's headlines, because that can derail people from the plans they have put forth, and certainly for retirement. And a lot of what we do, as advisors, I think, is sort of coach people through these experiences for better or worse, right? I mean, certainly we help people with planning, help them, with portfolio construction, figuring out the right mix of investments. But maybe where we really add our worth are times like this, when people are uncertain as to what to do, and they have really critical, really important dollars invested for things that are, crucial for them, if it's an education for your child or your own, financial future. So, I know that's important. People, naturally get emotional about that, and they need kind of an outside professional perspective. So, if people find they're losing sleep, they, just really not sure what to do, I would encourage them to seek help. If not me, somebody, that they can trust. And if there's anything I can do, they can read more about me and our firm on our website, which is Three Magnolias Financial Advisors. We are here in the Triad. We're here in Winston-Salem. So you can certainly check us out there. Give us a call. We're at 336-701-1600, and we'll help in any way we can. And hopefully this has been helpful for folks too.
I think it has been. I appreciate the level-headed approach and the perspective, the context, just to let people know, like, hey, like, this is, we're not trying to make light of what happened. I mean, yes, Monday was a tough day from a market perspective, but offering the perspective of, this has happened before. This is the context in which it happened, and then what you might advise people to do when there are these drastic changes one way or another. So, the information for Jennifer, she just mentioned it on where to find her. We'll put her contact info in the show notes as well. But Jennifer, hopefully, the topic that we had for this week can be brought up again next month, but we'll certainly adapt if necessary. So appreciate the time.
Yeah, thanks, Adam. It was fun.
Securities offered through Private Client Services, member FINRA SIPC. Investment advisory services offered through Three Magnolias Financial Advisors, located at 110 Oakwood Drive, Suite 480, Winston-Salem, North Carolina, 27103. Three Magnolias Financial Advisors and Private Client Services are not affiliated. Private Client Services is under separate ownership from any other named entity. All information is believed to be from reliable sources. However, we make no representation as to its completeness or accuracy. All economic and performance information is historical and not indicative of future results. The market indices discussed are unmanaged. Additional risks are associated with international investing, such as currency fluctuations, political and economic stability, and differences in accounting standards. The views depicted in this material are for information purposes only, and not necessarily those of Private Client Services. They should not be considered specific advice or recommendations for any individual. Neither Private Client Services nor any of its representatives may give legal or tax advice.
This is the Triad Podcast Network.